Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 129 on August 29th, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on NIO, Bank of America, and the S&P 500 ETF. And we discussed three new trades on Corbus Pharmaceutical, Freeport McMoRan, and Oracle Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. So looking at the markets this week, we see the market is back. I mean, it's been on an uprise, but it seems to be back now. The Dow Jones Industrial Average gained 723 points this week, closing at 28,653 points on Friday. The S&P 500 index gained 110 points, ending the week at 3,508 points. That is a huge rise. It's been a great run in this market, and as much as I'm uncertain how high will stay or go, I'm not really a fan of selling it right now either. So hopefully you guys managed to hold on to your positions through the March downturn, and I'm in awe of what's happened over these last, what would that be, 4 months. So anyway, let's get into the topic of the week. The topic of the week this week is on financing your option trades. At least that's what I'm calling it. So let's say that you've done your research on a particular stock and you see all the important levels, all the levels that matter for you technically. You see the support, you see the resistance, and you have some confidence that the stock is heading higher, and all of your technicals line up. Whichever indicators you're using are lining up saying, hey, this stock is about to go higher. So you switch from the charting feature of your trading platform over to the trading side, and you look at the at-the-money call options. You've decided to buy a call option and make some money on this trade, and everything's expensive. Like, let's say the call option is going to cost you, $2, which is $200 in real terms. Well, if you buy that call for $200, you know that if the stock doesn't perform the exact way you want, then you'll lose the entire price because you're buying that option. So if it doesn't go the way you want, you're going to lose your premium on that option, and you didn't really mean to, or you weren't really thinking of a $200 trade here. You were hoping for something better. So maybe you'd feel a little better if you could buy this option for $100. Well, the way you would finance this trade is by selling a farther out of the money call option against it. So maybe the strike that's $5 away has a $1 bid, meaning it's $100 in real terms. So and what if your research shows that you don't expect the stock to make a full $5 move higher, right? Maybe you're only really anticipating a $2 move higher or a $3 or $4 move higher. Well, then that's great, because in this scenario, you could sell the call option that's beyond the resistance level or right at the previous resistance level on the stock, and that allows you to buy the call option you really wanted for less money. So you're selling a further out of the money option to finance the one you really want. And the beautiful thing about it is you're still set up to profit for the full profit range that you anticipate from your research, right? Now on this show, I typically trade call spreads that are 50 cents or $1 wide in the strikes. I mostly do that so that you guys can see that there are thousands of trades available in the market at any given time for any size portfolio. I mean, you guys hear me talk about some of these trades that you're able to do. You're able to buy a spread, a 50-cent spread for $33. That's 33 real dollars, not, 33 cents, $33. So it's unreal. That's why I do that on the show. I want everyone to be able to research and find trades that best accomplish their portfolio, their individual goals. Sometimes that might include trading a spread that has a much wider difference between the strikes so that you can get you can capture the full value of the move that you anticipate in the stock while still being able to put it on with a little less risk, meaning a little less money than it otherwise would cost if you just decided to buy the option. So that's it. Get started. It's the same simple math that I use on small spreads. It works on the big spreads too. So get in there, do the research, and find ways to create the position that's going to help you to profit given the size of your portfolio and how you want to manage your risk. So that's it for this week's topic of the week. Hopefully you guys enjoyed that, and hopefully it makes a little sense, because I don't always talk through why I'm choosing these $1.50 spreads. You don't have to do that. You certainly can choose wider spreads. So let's get into the trade review for last week. We're going to start off with our covered call. We looked at NIO Incorporated. It's actually an ADR. It's N as in November, I as in India, O as in Oscar. At the time, the stock was trading for $14.12 per share, and I looked at buying stock and selling that September 15 call at $1.01, hoping for a return of 13.39% or almost 13.4% in 4 weeks. Well, NIO stock rose $4.38 this week. The option we sold picked up $3.19, leading to a net gain of $1.19 for the week. It's pretty good. Now, if we hold on to this trade for 3 more weeks, we can expect this trade to gain another 70 cents. So when a stock increases this much in a week, it's, I'm sure you guys look at it, it's tough not to wish that we just bought the stock and not been involved with the option at all. However, I'd say, a 13.4% return on capital in a month is pretty good. And actually, you've captured 2/3 of that already, or nearly 2/3 of that growth just in a week. So this trade has definitely worked as planned. No adjustments needed, other than just deciding how long you're going to hold on to the trade and seeing if you're going to be able to pick up the other 70 cents that's still on the table. Our second trade from last week is a credit spread. We looked at Bank of America, symbol B as in Bravo, A as in Alpha, C as in Charlie. At the time, the stock was trading for $24.98 per share. I looked at just selling the September 25-26 call spread at 34 cents, which can give us a maximum possible loss of 66 cents. Well, Bank of America stock rose $1.32 per share this week, which is not good. The out-of-the-money call spread we sold is now in the money, leaving us with a current loss of 34 cents this week. Now, you have the option of closing this trade, of course, and locking in the loss or selling another spread against it. We lost 34 cents. We know that we lost 34 cents. We know that our maximum possible loss is 66 cents. There's another 32 cents that can be lost in this trade. Now, because this trade is in the money, I'd actually prefer to close it. If we were to look to sell a put spread against it, the strikes would have to be lower than the call spread strikes, and those spreads right now aren't trading for much value. It's just not worth selling because you're not going to collect enough money to offset your risk. Now, if you were to close that trade, the spread that we've lost on, and turn around and sell two spreads, turn around and sell the September 25.5, 25 put spread and the September 27.5 call spread, you would collect 26 cents, which actually lowers your loss on this name from 34 cents to 8 cents. Now, this is a pretty interesting scenario because the new trade could still lose an additional 24 cents. So that actually, when you add on the 8 cents loss that you're still going to carry from that first trade, it leaves you with a maximum possible loss of 32 cents still on the spread. So that's exactly the amount that you could lose on the original short call spread. However, you would create a larger profit range, or a larger range where you could make money in this. So your profit range now goes from being a guaranteed loss where we are now to creating a range of $25.50 to $27 in the stock, where you'd only lose 8 cents if we finished within that range. And I didn't mention earlier, but stock finished at $26.30 this week. So that means that right now, you would actually create a scenario where your loss on this trade is 8 cents or $8 real. So the odds are still in your favor if you take on selling the put spread and the call spread instead of sticking with that original trade, or just closing it and locking in the loss. So you definitely have some decisions to make. The main reason why I wanted to share this whole process is so that you get a sense of how I look at this, because I don't look at a 1 week loss as a final loss. I really want to take into account whether I think the stock is going to remain higher where it is right now, and also see if there are any other trades that I can put on that just sort of lower the amount that I've lost, as well as put me in a situation where I might be able to profit a little more. So that's it for that. We lost on the credit spread last week, which I hate. But let's move on to the debit spread. We looked at the S&P 500 ETF, symbol S as in Sierra, P as in Papa, Y as in Yankee. These are known as the spiders. At the time, the stock was trading for $339.48 per share. We looked at buying the September 338-339 call spread, paying 68 cents for the spread. That can give us a maximum gain of 32 cents or a 47% return on your capital in 4 weeks. Well, as you all know, the S&P 500 ETF grew a ton this week. It rose $11.10 per share, closing the week at $350.58 per share. The in-the-money call spread that we bought is now even more. I mean, it's significantly in the money. This spread is so deep in the money that you might actually be able to close it for the full $1, which would allow you to lock in a 32-cent gain or a 47% return on your capital in 1 week of trading. Now, if you can lock in even a high percentage of your maximum gain in a short time frame, I say do it. The trade is still open until you close it, which means you can't count your profits until your money is fully out of the market. And if you're able to close this trade on Monday for $1, take your money off the table and go buy yourself a nice steak or something like that, 'cause you did a good job. So that's it for the trade review for last week. We have 3 more weeks of September trading, which may seem a little strange given that we haven't gotten into the month of September yet, but we're only 3 weeks away from September expiration. So we're still going to be in the month of September for this week's trades. We're going to start off with the company that we've looked at before, and normally I wouldn't use another stock that we've done so recently, but this stock is just it's just unreal, and I'm a sucker for these high option premiums. So our covered call this week is once again on Corbus Pharmaceutical, symbol C as in Charlie, R as in Romeo, B as in Bravo, P as in Papa. The stock ended the week at $9.12 per share. I'm looking at buying that stock and selling the September 10 call at $2.75, hoping for a maximum return of 39.8%, almost 40% on a covered call over the next 3 weeks. So you enter this trade by buying Corbus stock for $9.12 and selling the September call at $2.75. This trade makes the most money if stock prices finish above $10 per share and the break-even price is $6.37 per share. And in real terms, the stock purchase would require $912 and you would collect $275 for selling the call option. That is just crazy. Almost 30% of your actual stock you're collecting for selling that call option. Now, the second trade on the week, we're looking at a credit spread on Freeport McMoRan, symbol F as in Foxtrot, C as in Charlie, X as in X-ray. The stock ended the week at $15.65 per share. I'm looking at selling that September 15 put spread at 18 cents, which could give us, of course, a maximum possible loss of 32 cents per spread. So you enter this trade by selling the September 15 half put at 64 cents and concurrently buying the September 15 put for 46 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $15.50 per share. The break-even price on this trade is $15.32, and in real terms, you would receive $18 per spread that you sell and have $32 at risk. And then our final trade on the week's debit spread, looking at Oracle Corporation, one of the old software giants. Stock ended the week at $57.88 per share. I'm looking at buying the September 57 half call spread and paying 33 cents. And that could give us a maximum gain of 17 cents or a 51.52% return in 3 weeks. Now you enter this trade by buying the September 57 call for $2.68 and concurrently selling the September 57 half call at $2.35. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $57.50 per share. The break-even price is $57.33 per share. And in real terms, you'll pay $33 to enter the spread, and your maximum gain is going to be $17 per spread. Now, that's it for this week's trades. Thank you guys so much for listening. Thank you for sharing the podcast as well. I can tell by the way the numbers have been increasing. We're getting more listeners, more subscribers, and that means you guys are sharing it. So thank you so much. And hey, also thank you for the people that email me. I get a kick out of the emails every week. It's wonderful to get feedback and suggestions and also just questions. I mean, I love geeking out on options. And so if you do too, email me and we can talk. All right. That's it. Have a wonderful week. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.